Jonathan, thank you so much for joining us today. You were here a couple of months ago, and we still had so many topics to cover. So I'm so happy that you're back with wealth of information regarding syndications and funds. But first, why don't you please remind people what you do, and we'll take it from there.
Yeah, well, thanks so much, Stephanie. I must have not completely bombed the last time we spoke together that you invited me back on. But thanks for the invite, Jonathan Tavares, managing partner of Premier Law Group. Our firm is narrowly focused on helping real estate syndicators to raise capital for their real estate projects and real estate funds.
And like we said before, we use you guys. You guys are fantastic, extremely fast in responding on top of your game. So, highly recommend your services. And let's jump into the topic for today's conversation, which is SEC exemptions and compliance. What are some of the common mistakes that syndicators like us make, and how can we avoid these mistakes?
Yeah, so the first one that comes to mind, and this is probably a conversation I have at least 3 times a week with sometimes existing clients and a lot of times new or prospective clients, is not calling a spade a spade. What I mean by that is understanding what the difference is between a joint venture and an actual syndication where you're selling securities. So, the world that we sort of live in as a law firm is helping and guiding our clients with complying with the securities rules for raising capital for either project-specific syndications or in a fund model where they're acquiring multiple assets and raising capital from retail, sometimes institutional investors. But sometimes clients will come to us, especially with smaller deals, and say, hey, well, we're raising capital from investors who are going to be passive. Can we just call it a joint venture so we don't have to worry about doing a PPM, doing all those disclosures, filing forms with the SEC, filing forms with the states where our investors are from, and all of that? It takes up time. Obviously, there's a cost to the compliance, and sometimes that can be tough, especially for smaller deals. And unfortunately, you can't just dictate whether your deal is going to be a joint venture or a syndication. You actually have to have facts that support it. So, typically speaking, a syndication is going to be a model that we're going to set up where the investors are passive. If your investors are passive, you're selling securities. So if they're not actively involved in managing the underlying assets, or they don't have voting rights in the investment vehicle, then you're selling securities if they're passive investors. And so if they are passive, then you have to provide them with appropriate risk disclosures. You have to find appropriate exemption under the federal securities rules, and you also have to make sure that you're filing notice filings accordingly. It's called the Form D when you're raising capital under 506B or 506C, and the states also require you to send them notice filings as well. So it does take work, but it's the right way to do things if you're raising, again, from investors who are passive. Now, if you truly do have a joint venture structure, yes, you can avoid all of the securities compliance and not have to worry about a PPM, not have to worry about investor questionnaires, subscription agreements, and investor portals, and any of those things. If you have a joint venture where all of the partners are active and they're contributing something to the joint venture, and part of it could be capital, it can also be know-how. So in a real estate deal, maybe someone's a real estate broker, and so they come in with expertise on valuations and understanding the market where the underlying real estate's located, and they can bring other things to the table. Sometimes in development projects, you might have a joint venture where one of the partners is a civil engineer, or something along those lines. Maybe someone's an attorney, and so they can bring some of the zoning and the land use planning to they can bring those skills to work inside of the joint venture. But the key is in a joint venture structure is that the partners are actively involved in the management of the real estate. So that's the biggest thing, is your facts are going to determine whether you're running a joint venture or a syndication. And that's one of the biggest mistakes that I see clients make, is they want to dictate which which path they go down without considering the facts of their underlying situation. The second big thing, and this conversation also comes up on a weekly basis, is can you pay GPs to raise capital? That's always a question that I get. And one of the biggest mistakes is that a lot of syndicators assume they can because they see other people doing it. Um, and to be fair, in a lot of coaching programs that I've seen, I won't name any names, a lot of them are structured on the premise that as a GP, you can bring on other co-GP partners and compensate them for helping to raise capital. And that's a big no-no in the SEC world. So co-GPs that are brought on simply to raise capital have to be licensed broker dealers with the SEC. And in my experience, for most of our client base, almost none of their co-GPs are licensed broker dealers. There's a huge compliance cost. There's a lot of work to become a broker and to be able to get commissions or any sort of compensation for selling securities. I like to make the analogy. For a lot of clients of having a real estate license, right? Having a real estate broker's license, because essentially the rule operates the same, right? You can't share a real estate commission with a non-licensed real estate
Hmm.
broker. And so the rule is the same in the security space is that you have to be a registered broker dealer with FINRA in order to participate in any compensation. The SEC calls it transactions-based compensation if you're getting paid for helping to raise capital. Now,
Interesting.
that doesn't mean that that can't be one of the jobs that a GP has. For sure, that's one big, heavy lift, especially in bigger deals where you do have to raise a sizable amount of equity. And so that it's a consideration, but it has to be part of the totality of what they're doing. The SEC says raising capital has to be incidental to their other duties. So they can do things like be part of acquisitions. They can be part of asset management. They can be part of investor relations, marketing. And in fact, the more jobs that they have, the easier it is to justify what you're paying them, whether it be in straight fees or whether it be in equity that they're getting as a GP member, or any other compensation arrangement that you may have. So that's a really big one in the real estate syndication space, make sure that your GPs are actively involved and have real jobs in your syndications and funds and aren't getting paid just to raise capital.
Yeah.
Yeah, so that's a big one.
I've also seen a few people do that. So what would be a consequence if, the SEC finds out?
Yeah, that's a really good question. So the SEC has a lot of options at their disposal, and I always tell clients, I mean, for most deals, it's true. Is the SEC ever going to find out that you're paying GPs to raise capital? Well, maybe in a lot of circumstances, no. But it's not a problem until it's a problem, right? And
Exactly.
so generally, how those things come about is you have a deal that goes sideways, investors lose money, or the relationship between the GPs starts to deteriorate. And partners are looking for ways to get some money back, right? Because a lot of these things, center around money, right? I mean, as they say, follow the money.
Yeah.
So a lot of times there is money involved in when these relationships deteriorate, when these investments go sideways or start to go south. And so that's generally when the SEC might get involved because someone might actually start reaching out to the SEC, right? They may hire litigation attorneys and start sniffing around to see, how they can trip up the sponsor or see if there's any steps that they didn't follow. And the securities rules are a great place to start because the SEC is very much focused on protecting investors. And so if you've not provided the appropriate disclosures or if you have not disclosed compensation, or if you've compensated in a way that is not permitted by the SEC, those are always huge things that the SEC will hit you on. So to answer your question, a couple of options are at their disposal. The SEC is that they could just shut down the private offering, right? So they could require you to not continue to operate under the exemption you're operating under and require you to register your offering. So for most syndicators, that's just a deal killer at that point. If they can't continue to operate under a specific exemption from registration, then registration's not an option. I mean, we're talking like an IPO, right? Where it may take several years to put together an offering, and you may be talking big money, six,
Hmm.
seven figures, and so that's only going to make sense for pretty big funds. Um, the other thing is disgorgement. So if you've already sort of been operating your syndication, been making profits, cash flow, the SEC may require you to may claw back those profits from the GPs and require you to give back those profits into the company, and also pay back your investors' capital at that point when they shut down the offering. So they could take back profits. And again, this is all part of closing down that offering. In extreme examples, they could bar a syndicator from raising capital in the future and
Hmm.
future exemption offerings, or pay heavy fines, penalties, and we kind of like to joke about it because it's not very likely, but of course you could serve prison time, but
Yeah.
but that's generally in cases of fraud. I mean, I'm sure we've all seen cases like Bernie Madoff and things of that nature of securities fraud. So that's definitely at the top of the list in terms of most extreme penalties for not following the securities rules.
Got it. Thank you. Very helpful. So I know you and I have chatted about this topic before, but I think it'll be interesting for our audience to learn what how is a syndication structured when the LPs and the GPs want to hold a piece of real estate forever, in terms of infinite cash flow. I know it's not super common, but I do know that a lot of investors would love to hold real estate forever because, once you return the funds, they have to find another deal. So a lot of them just want to leave, be part of the deal for the long term and get some checks in the mail beyond the 5 to 7 year.
Yeah, that's a good question. And yeah, there's absolutely ways to do it. A lot of times the challenge then becomes, or the question then becomes, is that a model that coincides with your investing strategy as it relates to your investors, right? Is that something that your investor base is going to be aligned with? And so generally speaking, when the GPs want to be able to keep the asset long term and at some point either sort of refinance and buy out the investors, or have some sort of other capital infusion that allows them to buy out investors at a certain point. It's sort of a forced exit that we call like a call option that the GPs have the ability to exercise to buy out investors after a period of time. We definitely have run into challenges with some clients in trying to implement this in the past, and a lot of it has to do with the investor base. So it's something that you definitely want to have conversations with your investors about, especially your bigger investors in your syndication or fund, and make sure that they're aware at the outset what the long-term plan is, what the exit plan is. And in fact, in your private placement memorandum, this is something we're very focused on disclosing upfront, to make sure that when investors sign up for your syndication, they know what they're in for. And so typically when we do structure a call option, which is really it's a forced exit of the investors at a certain point in the life cycle of the investment. You want to consider how that buyout price will be calculated, and when you have the ability to exercise it. So I always recommend to clients um, they should at least have a certain minimum number of years that the investors can participate in the investment, so that if it is producing cash flow, or equity is producing additional cash flow over time because you're increasing the value of the asset, and in turn you're able to raise rents, or whatever the case is. So it's ultimately having an effect on whatever those monthly or quarterly returns are that are going to the investors, that you can at least guarantee them a certain amount of time in the investment to the extent that you're going to hold on to that property. For the most part, we always provide discretion for the managers to sell at any point. So, for example, you may have a 5 year horizon, strategy in a syndication, and then decide in, year 2 or 3, things are going really great. That as the manager, you sell, divide up profits, everyone's happy. Um, Now, in the call option approach, maybe the plan is to hold on to this property long term, but maybe exit the investors at year 3 or year 5. So in that case, you would build a call option that would have what we call a lockup period for the GP, where they wouldn't be able to exercise it for a certain amount of time. So that would provide some sort of comfort and protection for the investors, so that they know they can participate in the deal for that amount of time. So on the low end, I would say at least 2 years, but in a lot of cases, sometimes it's 3, 4, maybe 5 years, again, depending on the type of investment and what the long-term strategy is. But at least investors know they can participate for that period of time. And then the buyout price may be based on some predetermined rate. So maybe your projections say that the investors are going to get a 20% IRR, or maybe 25% IRR. And so at that point, you may say, all right, well, we're going to build the call option to generate just above whatever those projections are, or maybe significantly above, depending on, again, what the investor base would want in terms of returns, so that when you do exercise the call option after that lockup period, the investors are parting with you, but they're feeling that they've gotten a good return, because maybe it would have taken them another year, another 2 years, or maybe longer to receive the returns they would have otherwise gotten had the natural course of the syndication taken place. So that's usually the biggest challenge, is figuring out how you're going to value the underlying investment at the time that you exercise the call option. In other cases, it may be a multiple, or maybe a certain percentage above the fair market value of the property, as determined by a third party appraisal. Again, the theory behind that is, if you're going to buy out the investors, you want to make sure that they're happy being bought out. So sometimes that means giving them slightly above, market value, which may seem like an odd concept, right, at the time that you exercise it. But if the plan is to keep the asset long term, then you're probably not concerned with, overpaying a little bit to get investors out. If you know it's an asset that is going to produce significant cash flow and have significant equity long term.
That's awesome. Very helpful. Thank you. Let's move on to, what are some of the legal challenges and opportunities in real estate investing today from what you're seeing in the market right now, which is, a little bit a unique market at this point.
Yeah, it's definitely unique. I mean, with all of the news we're hearing all around the world, whether it's potential war, whether it's still talks of inflation and tariffs, and you look at the stock market and you look at all this news, it's like the stock market's been ignoring it and has been running up on a tear. And then you're in the real estate world and trying to figure out about all these different things that are going on economically, politically. Well, the good news is in terms of real estate, especially those involved in, multifamily real estate, which is a lot of our client base, we know that people are always going to have to live somewhere. So it's an investment that's not going away, although there's certain times that are more beneficial and maybe less beneficial to be in certain types of investments, for sure.
Yeah.
Um, I'd say one of the biggest challenges we've seen, especially in the multifamily space, and I'm sure you've heard this, you've seen it, maybe even experienced it with other colleagues as well, is some of the downturn in the multifamily space, as far as debt service. We saw a lot of clients several years ago getting bridge loans that were, 2, 3 year terms, and they were maybe fixed rates for that period of time. But a lot of them figured, well, I mean, we could just refinance after this 3 years, or heck, we're going to sell this property in 3 years, so it's not going to matter once we reach maturity for this bridge loan, but with the exponential increase in property taxes, insurance, especially in certain markets like in Florida and in Texas,
Yeah.
right, where there's been so much property that's been syndicated there over the last several years, and in some cases some oversupply. There's been a lot of oversupply in certain markets, yeah, specifically in Florida that I'm thinking, right? Um, it's led to situations where, in some cases, some of these multifamily properties and syndications, the cash flow is not even able to support the debt service and all of the fixed expenses on a monthly basis. So, at that point, then you're needing to make a couple decisions, right? So, I mean, either you try to weather it out, but if you're bleeding on a monthly basis, then maybe you've got to figure some way to refinance and restructure your debt, which in many cases, a lot of lenders were wanting to see higher ratios of equity, right? So it meant going back to investors and asking them for more capital, which is always tough when you issue capital calls to investors. It's not something investors like to hear about, and it's generally something that's really hard to get them to participate in. So that's one of the biggest challenges we've seen over the last probably 18 months is a lot of capital calls to try to, restructure the cap table in a lot of these multifamily syndications. So that's definitely been a big struggle. And working with clients to be creative in what they offer to their existing investors to try to get them on board to participate with some of these capital calls as they try to weather the storm of multifamily. Um, and so that's been a significant challenge. But on the flip side, that's also, I think, created opportunity. I mean, in many markets, a lot of prices have dropped for multifamily, and so that has provided some opportunity for syndicators as well. And so I am seeing that in some of our clients that are very active in operating funds and starting funds to be able to capitalize on the drop in prices in multifamily and a lot of favorable markets long term, but now are facing some struggles. So
Yeah, I keep hearing on my few masterminds that you should definitely call the bank and get them to reduce your loan amount because regardless, they're going if they were to take over the property, which they don't want to do, as we all know, they already lost that value anyway, regardless of who's going
yeah.
to buy next. So it's always, from what I keep hearing it from masterminds, a great idea to really have a serious conversation with your lender.
Yeah, and you know what? For good operators, I think a lot of them who are savvy, they know to how to navigate those conversations with lenders. They may be difficult conversations, but I think they're conversations that will be fruitful. But I think I'll call them capital raisers because there's so many in the syndication space that have been good at raising capital the last several years, but don't have experience or background or understand the importance of
Mm.
operating. And I mean, there were articles on the front page of the Wall Street Journal. I remember about a year or two back, just showing green pools in certain properties. And I think one in particular that I saw was in Texas of a particular
Yeah,
syndicator that had accumulated so many properties, and they'd raised a lot of equity, but obviously they weren't doing the work. They weren't doing the asset management. And so these properties were not being managed effectively. And then, sort of the trifecta, right, of these tax rates going up, insurance going up, and then not being able to manage their debt service once these, bridge loans expired, combined with not the right management experience to effectively, run these properties just I think led to a bad situation in a lot of cases, and some that just don't even know how to navigate those conversations with the
mm,
lenders either, but arguably maybe should never have been in the business of syndicating or should have brought the right people with them. So
exactly. Yeah, these people are probably, I would guess, not our listeners because they're not taking their job
that's right.
seriously.
That's right.
So that was wonderful, Jonathan. Was there anything else that we haven't touched on or I haven't asked that you think is important for our audience to know today?
So one other thing that I think is important to mention, especially in the syndication space, um, is some new rules around accreditation. I mean, I'm not sure um, how much your listener base follows the updates that the SEC puts out regarding accredited investors. Arguably, these are probably nerdy things that I'm involved in checking
Yeah.
week in and week out. But I think this does have an impact on syndicators who raise in 506C deals. So from accredited investors only, the SEC issued a no action letter, which is basically guidance that comes from typically it's a letter from a law firm that poses a certain set of facts of a certain client looking for some sort of feedback from the SEC to prevent some sort of future enforcement by them. So it's a way to get advice without getting hit with the stick on the back end from the SEC, which can be helpful not only for the individual who's writing the letter or the firm who's writing it on their behalf, the securities issuer, but also for under other syndicators as well. And so one of the things that they clarified is that typically in a 506C deal, you have to verify the accreditation status of your investors, which means they've got to have $1 million in net worth, excluding their primary residence, where they make $200,000 a year or more, 300,000 as a couple. And so that's the accreditation status, but the SEC says you have to take reasonable steps. So usually that means they have to go to a third party and send them all their financials, whether it's tax returns or W-2s, 1099s, and other financial statements, or they go to their CPA or attorney, get them to review their financials and write a letter that says they're accredited, which can sometimes cause a little bit of friction when you're trying to onboard investors and raising capital.
Yeah.
LPs that are pretty familiar with the process and have done it a lot realize that it's just a part of the journey, but sometimes it can be tough when you're building relationships with new investors. So one of the things that the SEC came out with is they said that an investor can be considered accredited on their face if they put in $200,000 or more into an offering as an
Hmm.
individual or through their entity. So a lot of clients have been using that as a way to create less friction with investors. So they'll create a class, sometimes a higher class, even if they weren't intending on doing it. For 200,000 plus investments, and they're able to tell investors, hey, it's actually a simpler onboarding process, and it gives them the ability to potentially raise more from investors as well because they can use that as an excuse, right, for
Yeah.
helping attract less investors
Yeah.
who bring on more capital in some circumstances. So
That's
that's been
pretty
an interesting
awesome.
development. Yeah.
I didn't know that. When did this happen?
So this was back in March.
Oh,
Uh,
fantastic. Thanks for sharing this
yeah,
great piece of news with everybody.
yeah.
Awesome. Jonathan, as always, wonderful episode. Thanks so much for making the time here. How can our listeners get in touch with you?
Well, I'll see if I can do it right this time. I think I gave incorrect website last time. So it's premierlawgroup.net. You can go there and take a look at the services that we offer and some of the resources that we provide there. My email is Jonathan at plglp.net. Or listeners can feel free to call me at 508-212-1193.
Jonathan, thank you so much. As always, all of this will be under show notes. I really appreciate your time.
Thanks, Stephanie. I appreciate it.